Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, we're going to discuss some key lines on your tax return from 2025, and you can use them for some 2026 planning. Joining me today is Allie. Thanks for joining me again today, Allie.
You're welcome.
She's going to help me get through some of these tax returns and some planning topics for you. As a brief legal disclaimer, our discussions here should not be construed as financial or investment advice, and in particular today, not accounting advice. I'm not an accountant.
Neither am I.
But we know taxes very well, so some things to do for planning. So that's what we're going to do, and each person's situation is unique. All right, let's go. Well, first of all, thank you for joining me. As I'm looking back to the podcast that you've been doing with me, it always be taxes. So you must. Are you sure you're not an accountant?
You know what? My retired tax accountant mother would be very proud.
Well, there we go. Yeah, shout out to mom.
Yeah, I guess it's in the genes.
Yeah, belated Mother's Day for your mother. So,
yes,
Mother's Day gift. So yeah, so definitely a great job with it. You know, there's always a lot of detail to get into. We'll highlight a few things as we go along. But
yeah, and I think this is kind of one of the things that we go deeper on than a lot of people.
Mm-hmm.
So it's definitely a big part of our services.
Yeah, for sure. Yeah. Big. If you can find a tax return, it's a risk-free return, I say. So you don't have to take on market risk to get that kind of return. So it's nice. So the topic, again, for those regular listeners and watchers, this is also a blog post. And so we'll pull up a few screens on the graph today that you can reference. And then a lot of the things we discuss, you can go back and later reference a blog post things that Allie mentions or I as we go through. But the approach we're going to take, so again, a high level, Allie's going to talk about like these 5 major components of a tax return. We're going to focus just on the 1040. So the first 2 pages of your tax return actually summarize all those numbers for people. So it's you get 70 pages, 100 pages. Really, the first 2 pages will be enough for what you can do. So and actually, as an example, on the screen now, you're going to see the top half, or at least page 1 of your 1040. So you'll see some red circles, and so again. Reference that later if you want, but we'll be talking about some of those red circles today. And then also, too, the below that on the blog post, we have just a brief description. Again, we'll discuss it today, brief description. But then there will be a third bullet point for those categories that, some of the changes recently. So what was it? The OBA, the One Big Beautiful Bill Act that was last summer passed. Secure Act, there's actually one that slipped in this year. And then there's a few other changes. So we'll mention them as we go. So, but enough of that rambling. So I'm going to turn it over to the person who said she's not an accountant, which she's not, but knows tax as well. Yeah. So why don't you take it away on these 5 major components?
Yeah, sure. So yeah, like Kirk said, what we're going to do is kind of break the 1040 into 5 categories and just kind of talk about, what makes up each category, and then also highlight like any planning opportunities that you can start thinking about as you're kind of going through the year this year. Because there's definitely some things that, you can control throughout the year that may help you next year when you're filing your taxes. So the first category we're going to talk about is the income section of your 1040 and all the different types of income that you may see on it. The first line will be your W-2 income. This is net of any employer deferrals. So if you, have any 401k contributions you're doing through your employer or HSA or commuter benefits, that number that you get on your W-2 is net of all those. So that shows up in the income section. Also, you'll see investment income such as interest or dividend income. Interest income, it's kind of nice to look at to see if you have a lot of bonds in a taxable account and you're in a higher tax bracket. Mm-hmm. This is kind of one area maybe to just take a look at and see if you've got a, higher number there, because that bond interest income, again, kind of contributes to your overall taxable income number. Yeah, so if that's something that you can kind of control by either putting those bonds in a different like tax deferred account,
yep, that's what I was going to say.
Or again, if you're in a higher tax bracket and say you can't, maybe look into like a muni bond. Yep. That's kind of one line of income that you may be able to control just by the different types of investments and location of those investments.
Yep.
The next type of income that you may see is dividend income. That is broken out into ordinary dividends and then qualified dividends. You'll also see, or I guess, one of the charts Kirk will kind of speak to later is with these dividends, like I said, there's ordinary and qualified, and the qualified dividends do have a lower tax rate.
Yeah.
So it's kind of, interesting to take a look at the breakout of those two, because ideally you want higher or more qualified than ordinary dividends, because you get a better tax rate on those. Another source of income would be IRA distributions. So if you're retired and you're taking RMD distributions, you'll see those show up on there. Also, if you're doing any QCDs, so qualified charitable distributions, that's again, it's a distribution from an IRA, so it's showing up as income, but you actually, aren't being taxed on those, but it still shows up there.
Yeah. And it's with those QCDs too. Like, so again, some of the changes taking place either last year on your tax return, you might have seen some of this, or starting in 2026. So the QCD you mentioned. So one thing, it's on your 1099-R, the withdrawals from IRAs. And so QCD is in there. Custodians were never required to break that out.
Which is, been very confusing.
So people, it's their responsibility to tell their accountants. So at least starting in 2026, they're required to at least put a code on your 1099-R. They're not going to break out the number, so you have to still keep track of that, but they'll have a code there. So just make sure you tell your accountant about if you did a QCD, provide them the amount, they're going to see a code. They're not going to know the amount. So let them know that. And then, the distributions, the conversions or the retirees with the.
See, I was going to say, so, RMD, even if you aren't required to do an RMD, you may still, one of the tax planning opportunities and strategies that we use a lot are Roth conversions. So if you do a Roth conversion, you'll also see, that amount listed under the IRA distributions. And then let's see,
the Social Security.
I guess the next source of income that you would see in that income section is if you're getting paid Social Security benefits. You'll see that listed on there. Most people's benefit is taxed. The highest amount they can tax is 85%. And usually most people do fall into that bucket. So 85% of their benefit is taxable. However, some people, depending on your income levels, a lower amount, like 50% may be taxable. This is another, I guess, planning opportunities / area to be aware of, because if you do fall in that bucket of where your full benefit or the full 85% is not taxable, if you decide to recognize more income, it could bump up the taxable amount of that benefit. So if you were thinking about, say, doing a Roth conversion, and right now only 50% of your benefit was taxable, you may want to make sure, if I do this Roth conversion, is that going to all of a sudden bump up my Social Security taxability to 85%. So maybe I don't want to do the Roth conversion.
Right. I even found sometimes when people do that, if they were in, like, say, a portion only taxable, they think they're in the 12% bracket, so they do a conversion, and suddenly the effective tax rate is like closer to 18 or 19%.
Right.
More of that Social Security is kicking in. So
exactly.
Definitely one to watch out for.
Something we call the tax torpedo.
That's right. That's right.
So be aware of how much of that benefit is taxable, and if any income is kind of bumping it into a higher rate.
Yeah.
And then let's see, the last kind of source of income would be your capital gains. You want to be aware of, the short-term and long-term capital gains, because kind of like the dividends, there's different tax rates. So short-term gains would be, taxed at your ordinary income rate, where there's a different tax rate for long-term capital gains. Another kind of planning opportunity here is, whether you want to harvest losses, if you have any losses, to offset gains. So say, it's close to year end, you have a, large gain amount, you can look to see if you can harvest some losses to offset those. Another kind of opportunity people don't think about as well is maybe harvesting gains. Taking more gains. Like we said, there's a different tax rate for capital gains depending on what bracket you're in. So actually, if you're in the 10 or 12% bracket, there's a 0% tax rate for capital gains. So, especially if you think you're going to be in a higher tax rate later, that may trigger, your gains actually being taxed. It might be a good opportunity to take some gains while you don't have to pay those taxes on.
Yeah, a lot of people don't realize that. And later on, I'll pull up the bracket graph and people will see. It's like, because when I talk to people about that, they're like, really? I can do that? So
Yeah.
again, and all of us that we should have said too at the beginning, this is all federal tax only. So some states may have taxes, but again, it's always much lower than federal. So that's a good thing to remember.
Yeah.
And one quick thing I on the terms of changes. So when Ali was mentioning the wages, net of any 401k contributions, et cetera. So one thing to be aware of in 2026 is if you're age 50 or over, you get catch-up contribution. That has to go into a Roth 401k if your income from that same employer last year was 150,000 or higher. So you may be thinking, well, hey, I'm maxing out my 401k. What's going on here? That's a new rule that went in. That's thanks to the Secure Act. So that's something new coming along. And then also just to be aware, there is no income limit to be able to deduct your 401k contribution. So,
so that's something too that,
take advantage of it if you can.
Exactly. Because down the road, when we talk about, other deductions and credits that you may be eligible for, a lot of those are income driven.
Yeah.
So you may not be able to get those where, your 401k, everybody can max that out no matter how much you're making. So
all this income, how do I make it lower?
Yeah. So,
okay. Make it lower?
So yes, there's a few different things you can do. So the next section we're going to talk about is deductions actually adjustments to income. And then we'll talk about deductions. So different kind of, you have this big income number and then, there's different things that you can kind of control to adjust that number. And that would be IRA deductions. If you're doing like an HSA contributions would adjust the income number. So it's important to, do what you can to get that down, because after you take those adjustments off, you're left with what's called adjusted gross income, which is one of the biggest numbers on the
big driver.
Tax return, because it drives a lot of the eligibility for different credits or deductions. And then if you're, say, on Medicare, it also impacts the IRMAA band you're in, which is, impacts how much you pay for Medicare premiums. So that AGI, or different versions of it called modified adjusted gross income.
There's just one, right?
Yeah, you wish.
Lots of them.
There's a lot of them. This is very different kind of variations of this AGI number, but this AGI number is kind of what determines, like we said, a lot of the future credits and deductions further down on your tax return.
Like, for example, we just mentioned before with 401ks, there is no income limit. It's all deductible. So, Ali mentioned the IRA deductibility. Yep, it's there, but there are income limits for that as well. IRAs, individual IRAs, income limits, look them up and just give us a call for help. It says no income limits, but you have to have a qualified plans. And then again, just a quick, again, for the changes. And so before we jump to the next section, the One Big Beautiful Bill Act, so that was the July of 25, went into effect. They changed many things, and we have a link to it on our blog post to go back to a summary of it if you want to look at it. But two big things for today. One, the SALT, so the state and local tax exemption. It used to be capped at $10,000, and now they expanded that to $40,000. But there is an AGI income limit. It might even be modified. Not even sure, but anyway, there's an AGI related income limit. But if you're above a 500,000 or higher, you start to lose part of it, and if you're above 600, it goes back down to the 10,000. And then the other thing, this one is very popular, the enhanced senior deduction. So it's $6,000 per person. Married couple gets $12,000. So everyone says, cool, bring it on. That was that campaign promise to not tax Social Security. They couldn't quite do that. So they give this extra senior deduction. That also goes away. I think it's at 150, between 150 and 250, married filing jointly. And if it's 75 to 175, or double check the website on that, but it does go away based upon income limits. And so again, these AGI importance, it's like, oh man, if I do a Roth conversion or realize some capital gains, so that AGI is going up,
right,
you're going to start to lose some of that.
Exactly. So again, kind of looking at that income section, all the different things you can control, look to see how it impacts some of these other things down the road.
So actually, taking a look at the deductions, there are two on the screen now. We're going to show up again. So earlier we showed you the page 1 of 1040. So now we're going to just up on the screen, you're going to see page 2 of line 1040. And that's going to get into these tax and credits that we mentioned, as well as some deductions. And so the first major distinction, deductions. So there's standard deductions or itemized deductions. Back in 2017, they raised the standard quite a bit, and they took away some things you could itemize, mainly the SALT. And so a lot of people recently were just using the standard deduction. I think it's about $32,000 this year for married filing jointly. 2025, they raised the SALT limit. And so now people, like here in Illinois, property taxes are a bit higher in Illinois. So between property taxes and just state income taxes, if your income was low enough to get the full 40,000, a lot of people might be itemizing again. So take a look at that. That was a big change. And then the other thing too that changed were charitable contributions. And so that's part of the itemized deduction. Again, in the past, you may not have been itemizing, so it didn't matter anymore. Well, starting in 2026, because of the OBA bill, if you are itemizing, you can't use the full amount. You're going to lose the first 0.5% of your, again, AGI, that important number. But if you are taking the standard deduction, the good news category is you can actually now deduct, even if you're taking the standard deduction, up to 1,000 if you're a single filer, or 2,000 married filing jointly. So a few things to look at. And then again, new line for 2025 on line 13B, I guess it's called. It captures all of those special deductions. And so the most important one that people get excited about, the senior enhanced deduction, that's going to show up on line 13B if you qualify. Again, you got to be over age 65 and under income limits. And then there was also tips, overtime, interest on certain cars. You have to be, different rules on what type of car. But anyway, that's where those deductions show up. And so take a look at that. And then on the taxes and credit side, and so a bit lower in there, you've got your taxable income. So again, the AGI less the deductions that we talked about. But in addition to that, there's also these tax credits that you can get. And so a couple of big ones, I think, so I'm just looking up here. Yeah. So there's a few of them to be looked at, but two big ones to be aware of are, one, there is the child tax credit. Is that what it's called? Yeah, child tax credit or dependent care. Again, driven by income. I think it's AGI or modified AGI again. But I think it's around in the 400s for a married filing jointly.
Right.
Before you start to lose it. So take a look at that. I think it's a couple thousand per child.
Yeah. I was going to say, again, like Kirk said, this is one that does unfortunately phase out based on income levels. But yeah, I think it's up to 2,000 per child. Is a nice credit for sure.
Yeah.
If you qualify for it.
Yeah. And then another one that kind of gets in the weeds. And so maybe just for time, I'll mention it. Give us a call if you have questions. The American Opportunity Tax Credit, I think it's called, but basically for college savings. So if you use, I love 529s and I encourage people to use them. But if you qualify, again, AGI limit, I think it's around 160,000. If you pay non-529 money for college and your income is low enough, you can pick up a very nice tax credit there. So something to look at. And then the other thing too, I should have mentioned this a bit earlier, but I'm going to show up on the screen now because I promised it earlier. You'll see on the screen now an image of the tax brackets. And so that lets you know when Allie was talking about ordinary income versus capital gain income or qualified dividend income, the ordinary income, the taxable income line is just a total line, but really they break that apart behind the scenes into ordinary income that goes through the brackets. And then after you use up certain limits, it runs through the capital gains. You'll see on the screen there, your normal ordinary income tax brackets are, tax rates, I should say, are always higher. So on the far right-hand side is the capital gains tax rate. Those will always be lower. And so therefore, when Allie was mentioning being aware of the different types of income you have, lower tax rates are always better. So if you can push your income, recognize your income or get that type of income accordingly. So anyway, that's the a quick summary of the deductions and the tax brackets. I guess there's one last piece to the major components, I guess.
Yeah,
right?
Unfortunately, the payment section. So yes, line 33 actually shows, so far what you've paid in for the whatever taxes you've owed. Line 33 shows what you've paid in through the year, whether it's through your employer or estimated tax payments. So this is kind of a good indicator of whether you need to make any adjustments to your W-4 or estimated tax payments. So if, you haven't withheld enough and, there's going to be that underpayment penalty, going forward, you may want to go, next year plan to adjust those so you don't get stuck in that situation again. But take a look, see what you've paid in. The goal really, a lot of people get super excited about a refund. And actually we would say that, the goal isn't necessarily to get a refund because that's kind of giving the government your money early and you could have been earning maybe some interest on that. But really,
or having some fun with it.
But the goal really is to, either owe, very little, so you don't want to overpay, but as long as you owe enough to be within that safe harbor payment amount, that's kind of the goal. That means you did kind of a good job pacing yourself in terms of withholding. You were on track with that, but that's just one, thing to think about when you're, determining how much you should withhold or make estimated tax payments.
Yeah.
The goal is to possibly have even just a small payment amount.
Mm-hmm. Yeah, and withholdings too, I guess, on two major types. So one, those still working,
right?
Then you're going to have that most of the people have wages being withheld through the payroll, and so the W-4, however you set that up, is what draws it out. One thing to realize that you the users, you control that W-4. So if you don't like the amount that's being withheld, pull up your W-4 and talk to your employer and adjust it accordingly, because that is what's driven is whatever you filled out. You may not have remembered it way back when on your first day of work, but that is how it works. And then those that in retirement, again, they have no wages, and so there is no tax withholding. So the two key ways for them to make estimated payments or to pay into the system is, one, if you're Social Security, you can have your tax withholding set there. If you have a pension, not many do, but you can withhold taxes. And then also when you're taking any distributions from IRAs, whether it's required RMDs or just taking them out for living on, you can set what tax amount you want them withheld, and then they take care of submitting it. So that's a way to handle for retirees.
Yeah, we've done that for a lot of clients. Even if they've realized they're not withholding taxes on Social Security, we'll hold extra through the RMD or the Roth conversion. There's other ways to kind of take care of that withholding.
And then for both the people still working and those in retirement, those are levers you can pull. If you one lever that's not captured anywhere is if you have like large capital gains. So you realize gains, and if they're larger ones, there is no mechanism to withhold taxes for that. And so everybody has the estimated tax payment machinery. So it's 4 times a year: April, June, September, and then January 15th of each of those months. You can make estimated tax payments into both federal and state if you want to true it up. So again, you want to be on pace so that you don't have any penalties if you can avoid them. So anything else on the major categories? Is that
no? I think
so. You're saying I do have to pay taxes, and I thought there was a 6th category with the
sorry,
the free button. I have an easy button on my desk. There's no free button.
Yeah, no free button.
Okay.
Especially with the government.
All right. Yeah. Well, anyway, who said taxes aren't fun? Right. That was kind of fun.
Oh well, a lot of information.
So it is good. I mean, again, most people, you get that damn tax return, you throw it in the drawer and your electronic file, or don't delete it. You got to keep it for a while. But anyway, the main point is grab that return, take a look at some of these key lines, and there's things you can do now. So you're preparing your tax return. Let's fast forward to next spring. 2026 is over. It's like, darn, I wish I would have done some of these things. And so that's why we're letting you know what you can do. So
yeah, exactly.
Definitely take a look. And also it's a Memorial Day weekend. We're recording this on Friday, May 22nd. So happy Memorial Day weekend for everybody. Enjoy the extra time off and festivities, but also let's not forget what the weekend is for. Those who've died in service of our great country. So they made the ultimate sacrifice for us. And so let's keep that in mind as well. All right. Well, that's a wrap on today's topic. Thanks a lot.
Thanks.
Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.